Now that we know the basics, let's talk a little bit about the structure of the Forex market. First, we have to understand the major participants and what they do. What is their function in this market? Well, when we think about participants, the first thing I want you to think of is the interbank. Okay, that is the heart of the Forex market. In addition to the interbank, we have major corporations who are huge players in Forex. We have hedge funds and institutional investors who have been trading the Forex market for decades. We have Forex market makers who are up and coming in the hierarchy of the Forex market. And of course, we have the individual trader. Let's take a look at a graph of how they line up. I want you to think of the interbank as the world's largest banks trading among each other, buying and selling huge volume of currency 24 hours a day. That is the heart of the Forex market. That is where most of the volume emanates. So, in the interbank, which is not a specific place, but really a loose affiliation of large banks, this is where the spreads are the tightest and the volume is the highest. Those who are close to the center, but not quite in the center of this circle, would include major corporations who are huge Forex players because, frankly, they have to be. Think of a company like General Electric, for example, doing business in dozens of countries around the world. They have to be involved in the Forex market by necessity because of international trade. They're not going to pay their employees in other countries in US dollars. They have to be involved in the Forex market. Think of the big institutional traders, hedge funds, institutional investors. Forex has always been their domain. The reason why is because they trade large sums of money. And the Forex market is so big and so liquid that you can place very large orders without disrupting the market itself. We talked a little bit about Forex market makers. Okay? If a Forex market maker is doing, for example, 1 million trades a month, that definitely draws the attention of the interbank, and they're going to have direct relationships with the members of the interbank. And of course, there are smaller banks who are perhaps not big enough to be one of the main commercial bank big players in the interbank. They're a little bit outside the circle, but they might do significant volume as well. Now, the farther you are away from the center of this circle, the wider the spreads become. Think about a retail brokerage. Perhaps their main business is selling bonds or mutual funds or equities, and perhaps they're doing foreign exchange as a sideline. They're probably not doing a tremendous amount of volume, so they're going to be a little bit farther out on the hierarchy, and their spreads are not going to be as good. Individuals, no matter how large they are probably not big enough Forex players to really get into the heart of the matter and do business directly with the interbank. Okay? How about, we spoke earlier about travel. When you land in a different country, take a look at the spreads on the currencies the next time you land in a foreign airport. You're going to see that at the airport kiosk, you're not exactly getting a tight spread. The spread might be thousands of pips. That's because there's very little volume involved in that transaction. So you can see that the more volume that you do, the closer you are to the center of this circle. And the closer you are to the center of this circle, the tighter the spreads become. Let's talk a little bit more about the interbank. Think of this as the heart of the Forex market. This consists of the major commercial banks of the world buying and selling among each other. And about 75% of all of the overall Forex activity comes from the interbank. These banks are dealing directly with each other. There's no middleman. So each bank must have a credit relationship with the other bank. Of course, due to the tremendous amount of money involved, each bank must have a prearranged credit line with the other in order to do business. The banks can also trade with each other through EBS. It's an electronic brokerage system, and think of that as somewhat similar to NASDAQ Level 2, for those of you who are familiar with equity trading. And by the way, if you're wondering where your Forex market maker derives their prices, they are deriving their prices from the prices in the interbank. Okay, so that's the interbank. Let's talk about major corporations. We spoke a little bit about, for example, General Electric or another major corporation. Because of international trade, they are forced to become major players in this market. They may need to make payments to a foreign entity for materials or for labor, and that's going to require an exchange of currencies. Major corporations also hedge. They use the currency market to reduce risk. Let's take a look at how that might work. I want you to imagine Corporation A, which is based in Switzerland. They're an importer. They want to import a large order of products from Corporation B, a Japanese exporter. And that order is to be filled 6 months from now. Now, Corporation A, being based in Switzerland, generally deals in Swiss francs. However, they're buying goods from Japan. They're going to have to pay in yen. So think about that for a minute. What is the risk to Corporation A? What's the worst thing that can happen as far as Corporation A is concerned? The risk to Corporation A is that the Japanese yen will appreciate in value versus the Swiss franc over the next 6 months. Think about it. They're importing the products from Japan to sell them at a profit. However, if the yen appreciates, the products become more expensive if the yen appreciates versus the Swiss franc. How to protect against something like this? Well, Corporation A could offset its risk by buying or going long yen futures contracts. So, for example, if the yen strengthens, Corporation A will lose money on the exchange rate, but will gain that money back because they are long yen futures. Essentially, they've made a bet in the futures market that the yen will rise. Also, another way to eliminate this risk is by physically exchanging the Swiss franc for the yen at the current rate, and then just holding the yen for 6 months. Either way, what you're doing is eliminating currency risk. So this is called hedging. This is why many corporations are involved in the market. And in fact, it's a big advantage for traders because there's always liquidity out there. We talked about how this market is so big and so liquid. It's because there are many players in the market who are not even trying to turn a profit. They're simply there because they have to be there. They have to hedge against risk. What about institutional investors, hedge funds, big institutions? Forex has always been their market of choice. Again, because these institutions tend to deal in very large sums of money. Now, if you've ever traded equities, perhaps at some point you've traded an illiquid stock. Now, I'll give you an example. Perhaps you've traded a stock that maybe does 50,000 shares a day in volume. You place an order to buy 10,000 shares. What's going to happen? The market will immediately react to your order before you have even bought a single share. The market reacts to that big order. Heck, it's equivalent to 20% of the average daily volume. Of course it's going to create a reaction. Can you see how institutions and big hedge funds might have a problem trading a market like that? That's why they've always been involved in the Forex market. They can enter large-sized positions without skewing the market because of the tremendous size and liquidity of the market. What about central banks? We talked about big corporations. We talked about big commercial banks in the interbank. What about central banks? Well, a central bank is very different. A central bank is the principal monetary authority of a nation, and a central bank oversees that country's monetary policy and regulates credit conditions. So each country has one central bank that is essentially in charge of interest rates and monetary policy. Some of these main central banks are, for the United States, it's the Federal Reserve. Okay? For the European Monetary Union, it's the ECB, the European Central Bank. Okay? The Bank of England is the central bank of the United Kingdom, and the Swiss National Bank is the Central Bank of Switzerland. Japan's central bank is the Bank of Japan, and Canada's central bank is the Bank of Canada. Australia's is referred to as the Reserve Bank of Australia, and the Reserve Bank of New Zealand is the principal monetary authority for New Zealand. Let's talk for a minute about intervention. Sometimes central banks will enter the currency market in an attempt to force exchange rates to more favorable levels for their country. When a country's currency strengthens, that country's exports become more expensive. And, for example, the Bank of Japan has been known to intervene on behalf of the Japanese yen on numerous occasions. So what they're trying to do, you see, Japan's economy is export-driven. It's based on exporting goods. So the Bank of Japan will actually step into the market if the yen gets too strong. They will actually step into the market to protect the interests of the exporters. The most commonly used tactic by the Bank of Japan is to sell Japanese yen in the open market in large quantity and simultaneously buy a large quantity of US dollars. What that's going to do, it actually forces the yen to weaken versus the US dollar, and it causes the exchange rate of the US dollar-Japanese yen pair to rise. Now, by weakening the pair, the Bank of Japan is protecting the interests of their big exporters. And of course, exporting makes up a major part of the Japanese economy. But I want you to know, don't be afraid of this. Don't be worried about that intervention can occur at any moment, because it really doesn't work that way. Intervention rarely comes as a surprise. Central banks often will signal their intentions well in advance of an intervention. They're going to let you know that they're going to intervene by using certain code phrases when they're considering intervention. The Bank of Japan has some very famous and popular code words or code phrases, such as, "We are watching exchange rates closely," or "We will protect against sudden moves in the forex markets." Another one is, "Exchange rates should reflect fundamentals." Now let me ask you something. Why would the Bank of Japan signal their intentions in advance? Why are they signaling to us that they're going to intervene in the market? Well, the reason why they're telling us their plans is because they're hoping to move the market without having to actually resort to intervention. See, intervention can be very expensive. You have to put a lot of money in this market to move it. And frequently, even a central bank intervention fails to move the currency rate to the desired level. So, what the central bank is doing is called jawboning. They're trying to talk the rate to the level they want. You see, the mere hint of intervention can create the desired effect, as you and I and everybody else assume that the intervention is going to occur, and we take our positions right alongside the central bank. Now, the problem with this is, if the Bank of Japan or whatever central bank is intervening, if they jawbone too frequently without acting, in other words, if they cry wolf too often, it will lose the intended effect. Now, for example, in this chart, we have a very severe downtrend in the US dollar-Japanese yen pair. And, of course, that means that the yen is growing stronger versus the US dollar. So the whole time that this pair is falling, the yen is gaining strength. And, of course, the Bank of Japan doesn't really want this to happen because it's having a negative impact on Japanese exporters. So what begins to happen? First, You might see some sharp spikes upward as the Bank of Japan tries verbal intervention. That actually works for a while, but it's a temporary fix. And after a while, the market stops listening. Then you see a huge move upward as the Bank of Japan gets behind this currency pair and actually pushes it 700 pips higher from the 105 area up to the 112 area. They put a tremendous amount of money behind that. And what they're doing when they're intervening is they are selling the yen and they are buying the dollar in large, large quantities. By intervening in the market, they're pushing the exchange rate up, making export prices cheaper so they can sell more goods. And they're also allowing the exporters to hedge their positions at a better rate. That's why interventions occur. But it is not a frequent event, it doesn't happen often, and it's really very rarely a surprise.